to the sun. All in a dream, flickering silently beneath a black screen.
All right, here we go. Let's give this a try. All right, we got some people here. Hell yeah. Awesome. Okay, wow, holy moly. That was intense. What was that? 2.5 hours of just fastballs the whole time. Fastball, 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 fastball. What an incredible masterclass of an earnings call. I can't say I've watched too many earnings calls, but I don't think there are many that kind of happen like that. It's pretty impressive when you have the chairman of the company and the CEO and the CFO come up and outline the entire investment thesis for hours on end, explaining what's going on here. And, in reflecting on what I saw, it's continuously very apparent that education on what strategy is doing is what strategy is doing, education about Bitcoin, education about these financial products is continuing to be a bigger and bigger responsibility moving forward into the future. And anybody that was watching this earnings call today is going to be so much further ahead of anybody trying to digest what's going on with strategy, the products that they're offering to the market, what's going on with Bitcoin, why Bitcoin's rising, how to think about risk framework, how to think about portfolio theory, how big capital is moving in different pools, different institutions understanding different risk frameworks, the need for credit ratings, the need for corporate adoption of Bitcoin, the need for expanded information sharing in this environment. So I can't see if you watch this earnings call and you're not bulled up. I can't help you. This is if you haven't watched it, I highly suggest watching it, or just watch this. I'm going to try to run through, I think, what are about like 20 favorite slides and just some reflections on some of the slides and content here. I'm going to be digesting this for months. I think the traditional capital market is going to be digesting this for years. And anybody that's here now is just so far ahead of anybody else. So I am going to jump right into it. So the first slide I'm going to start with is slide 21, which is fitting, which is the 4242 capital raising plan. So, earnings call on October 30th for Q3 24 was the announcement of this $42 billion capital plan. So basically, if you cut this screen in half, you cut this picture in half, there's a $42 billion capital plan, $21 billion of ATM, $21 billion of fixed income. And now that they're, right at the $21 billion of ATM issued, they're issuing an additional $21 billion ATM on MSTR, the common stock, and expanding their fixed income capital plan to be $42 billion. So $84 billion in total. It's not like they've, erased the original $21 billion capital plan on the fixed income side. This is accretive, right? This is additional fixed income that they're looking to issue in the near future. A lot of the focus is on the fixed income. Fong mentioned it, Saylor mentioned it, the leaning into the fixed income side and increasing the leverage on the balance sheet, utilizing the fixed income is on the horizon. There's significant education that needs to happen in order for that fixed income to in order to issue a lot of this fixed income. And there's a lot of education, a lot of teaching of explaining what the risk is, outlining risk, working with rating agencies. A lot of marketing needs to be done, right? A lot of people have asked, like, why aren't they leveraging the balance sheet? Why aren't they issuing more convertible bonds? So it's like, well, it's a complicated equation, but in order to issue a lot of this or more of these instruments, and in order for them to be the most accretive to the MSTR shareholder, you want them to be in the most efficient instruments. You want them to be in strike. You want them to be in strife. You want to issue as much as you can of these more accretive instruments than the convertible debt, which requires a lot of marketing, requires a lot of education to explain to these different capital pools. Because remember, we're in a very small world here in the Bitcoin world, and a majority of the financial world, traditional financial world, turns a blind eye to Bitcoin and anything Bitcoin related or crypto related. So if you mention the word Bitcoin, they immediately gloss over and will start laughing at you for investing in Bitcoin, and will tell you about FTX and how everything's going to collapse. So you just got to understand that the traditional financial capital market sees the crypto market as just incredibly risky. So I thought this was a great slide, right? It's outlining, it's just an additional $21 billion of ATM and expanding the fixed income capacity for a total of $84 billion capital plan. So 32% complete with that capital plan. A lot of people have also been really frustrated with the ATM, but as Saylor and the team mentioned here, the ATM is incredibly important for de-risking the balance sheet and provides that capacity for leveraging up your balance sheet, right? So, I've talked about this every single week on MSTR True North, where we focus on the leverage ratios. Utilizing the ATM has helped bring the leverage ratio down with permanent capital. So you have the ability and the capacity to issue $35 billion of fixed income, right? Without the ATM, they would have a far less ability to leverage up the balance sheet. So this is a long horizon trade. You got to think about, you need capacity and protection to reduce the risk and make the fixed income instruments viable in the market. And that's what the ATM has done, is allowed for this potential capacity to issue a ton of these instruments and keep the risk relatively low and investment grade, as we'll talk later in the presentation. So that was a great slide. I'm going to start with that one, and then I'm going to jump over to slide 31, which Andrew explained very well. So, right, we're thinking about fixed income. You've got convertible debt, you've got strife, you've got these fixed income instruments. And one of the really fascinating things about strike and strife that maybe not a lot of people really understand or recognize is that strike and strife are perpetual. It's perpetual debt. And perpetual debt means that it doesn't have an expiration. That means, all of that capital is not going to come due at a point in time in the future. So you don't have to refinance that debt. And when you look over at the bottom here, so a traditional bond with a 5-year maturity, right? So you get $100 million in the door, you buy Bitcoin with it, you pay the coupon, and then at the end of 5 years, you got to repay the $100 million. And how do you do that? You refinance the debt, or you sell Bitcoin, or whatever your financial capacity tells you to do. So you got to refinance that debt at a future point in time, get another $100 million, and then run the playbook over again. Now with strike and strife, what makes them incredibly powerful and valuable is that they're perpetual, and you don't have to refinance them. You get it in the door, and there's not an exit ramp. You could sell those products on the open market, and somebody's going to buy them from you, and that impacts the yield and the liquidity and the depth of the market. So these instruments are, when you're looking at managing the risk of your balance sheet, these instruments are incredibly valuable, right? You don't have to, you're not going to have the entire world of Citadel and all of these FUD people coming out saying, how are they going to pay for the debt at a future point in time? Well, guess what? It's perpetual. I don't have to. And I just have to be able to, pay the dividend over time. So good stuff there. And then I'm going to shift down to here. Why does this work? So seniority and volatility of our BTC-backed securities. I thought this was a really good slide because it is outlining the relative seniority and the volatility of each one of these instruments, which is important, right? So the seniority affects the risk, right? If you're more senior in the capital stack, that means you have less risk. So one way to look at this is if you're higher up on the y-axis, the seniority curve, it's less risky, and on the volatility curve. So, or you're closer to, Yeah, you're more senior. So in the event there was a bankruptcy, you would be uh, you would be receiving that. You would be paid out before all of these other instruments. So MSTR is the least senior, meaning it's uh, if there's any money left over, like MSTR gets it in the event of a bankruptcy. That's the way to think about this framework. It's the most volatile. It's the highest risk return. You are taking on the most risk here. But if you are bullish Bitcoin, this is a very high octane place to operate. Now you see these other instruments, strike being right in the middle of volatility and seniority. So if you wanted to, manage your downside, get paid 8% fixed dividend, and still have some upside, right? Like that's why it's still on the volatile side. Is if the price of MSTR is over $1,000, this is convertible into equity. If you don't want any of that uh, conversion volatility, if you don't want any of the upside, you want to just have supreme downside protection, but backed by Bitcoin, that's where Stripe comes in. 10% fixed dividend, non-callable, it's preferred, it's perpetual, it's pretty senior, it's more senior to Strike, it's more senior to MSTR, and it's far less volatile, right? It's basically, it's going to stay relatively flat. Um, the price of Strife will go up once the market recognize how little risk is in this particular instrument. And now the convertible bond is somewhere in between. It's most senior, however, it's more volatile because there isn't this fixed dividend component. So it is moving around quite a bit more. You've got the convertible bond arb traders that are hedging, going both directions, and they're trading this thing back and forth. So it's they're leaning into that volatility component. Okay. I'm going to shift over to slide 38 and 39. And this is where it starts getting crazy. So Saylor popped in here at slide 36 and just went on this, MIT masterclass of financial markets and building out the future of Bitcoin financial framework for the future. And this is going to be taught in classes for the next 100 years, probably. I wouldn't be surprised if we see this continue to pop up over time. So the next two slides, he outlined this slew of different terms in financial frameworks. So you've got these KPI frameworks: BTC yield, BTC gain, BTC dollar gain, valuation framework metrics, credit framing metrics, BTC rating, BTC risk, BTC credit hurdle. And it was, and then the second slide here is outlining forecast, BTC AIR, volatility, BTC treasury, all of these different components, and then getting into BTC risk here. It's awesome to see this as a common stock shareholder. I'm fascinated to see these because that means that they're managing this entire ecosystem, right? They're managing the entire ecosystem, and they're taking every possible perspective on managing the balance sheet here. This isn't like some just shoddy shop just taking leverage on Bitcoin and not having some really well-defined metrics that are driving perspective here. This is very calculated. These are all brand new metrics that have never been used before, but can give you some perspective on the efficiency, how to value the credit framework, how to value the risk framework, how to start comparing different risk instruments. So in different marketplaces, how do you compare risk of one instrument compared to another instrument? And it really gets into this risk component, which I'm excited to talk about in the bottom here. So diving in a little bit further, I'm going to go to slide 48. Oh, this is where it gets fun. So getting into torque. Yeah, so Dana, here's torque. Yeah, torque for sure. And so here's a Bitcoin torque comparison for a 1x mNAV. So I guess before I get into this, it was also really fascinating that the Saylor spent a lot of time talking about mNAV, this multiple on net asset value, and giving the market a really clear understanding of how he thinks about mNAV, how he thinks about all of these different instruments, how all of the different instruments are valuable at different components at different points in time with different mNAVs. So he's effectively laying out the toolkit, right? Like, here's the toolkit that we have. Here's how all of these different instruments are accretive based on these different components in the market, right? If mNAV is at a different value, here's how much accretion value this leads to MSTR stock. Here's how it will impact the trajectory of MSTR on the long horizon, depending on your assumptions of what Bitcoin ARR, so what Bitcoin is going to do on a compounded basis over time into the future. So the Bitcoin torque was interesting. So I like how he's got this laid out. So it's the change in BTC dollar value over the change in BTC capital invested. And what this is showing, in my opinion, is like the leverageability, like how impactful are these instruments at different Bitcoin compounded annual growth rates relative to each other, right? So if you follow my cursor here, so if you're a Bitcoin investor and you think Bitcoin's going to compound at a 20% compound annual growth rate, if you issue ATM at a 1x mNAV, it's basically not accretive, right? You're adding additional Bitcoin to your balance sheet, and it's just boosting your balance sheet. So zero kind of torque or leverage. And the convertible notes at a 1x mNAV, right? Because they're issuing the convertible notes at like a 50% premium. So you got to think, if Bitcoin compounds at 20% annually for 10 years, that 50% premium gives you additional leverage, and it's a 1.x times torque. And Strike, which is a further out of the money conversion premium, gives you even more torque. And given that Strife doesn't even have a conversion premium, it's even more torque, and it's more impactful. And the reason being, right? So Strife, you're not going to have any conversion into equity. Like, there is no equity share dilution. With Strike, there's technically equity share dilution, but theoretically, the buyer of Strike is going to hold Strike into perpetuity because they're getting paid a dividend on that, and they have no incentive to convert unless they needed to, sell to buy another instrument or something like that. So, when you're looking at this, just on a base level, you would say, I want MSTR to issue as much perpetual Strife as humanly possible, because it's got the most torque on the underlying share price at a point into the future. Now, the only way you can do that is if you have a balance sheet that can support the issuance of these different instruments. And so maybe it makes sense to go to the next slide. And I like how he's got this laid out. Is he shows that how at different mNAVs, the different multiples, right? So if the equity is trading at a multiple of the underlying asset value, issuing ATM is actually accretive, right? Like you get torque on the balance sheet because you're issuing at a premium, and this is increasing Bitcoin per share. But as you can see, there are other instruments that are increasing Bitcoin per share at a higher rate, I guess. So, and he shows this in multiple different mNAV circumstances, right? 1, 2, and 3. And it makes sense, right? Like, if you look at the relationships holds true for MSTR, convertible notes, and Strike for going up at different mNAV values, 1x, 2x, and 3x. You'll see that the torque is increasing. However, the torque is staying the same for Strife because because it's a fixed instrument, right? It's a fixed instrument, and it doesn't convert into any equity or any different shares. So he pointed that out in this in these 3 slides here. I need to digest this one a little bit more and just think about this from an engineering framework. But I like how he's got it laid out. Next one, slide 57. So BTC break-even price and BTC break-even rate. So I loved this one too, because this is exactly how I think about the leverage on the balance sheet and how I think about these instruments. So I'm really glad he put this into words here. So what what Saylor was attempting to do with all of these slides was to show the different risk return element framework of all these different instruments, right? He's showing that MSTR is, deleverages the balance sheet, protects the balance sheet. All of these other instruments leverage up the balance sheet, and they have different risk return frameworks, and they have different impacts on the underlying, uh, you know, architecture and the development of the balance sheet construction, right? The construction of the balance sheet. So when you issue, so I like how he's got this laid out here. So when you issue MSTR equity, so let's just say these are all different Bitcoin prices that you could see here. So this is assuming the Bitcoin price today is 95,000. So at a 1x mNAV, when MSTR issues equity with Bitcoin at a 1x mNAV, which is not right now, that means 10 years into the future, Bitcoin can have a 0% compound annual growth rate 10 years into the future, and you'd be no better off, no worse off. Now, if you look at a 2x mNAV, you go down the screen here. Basically, if you issue stock at a 2x mNAV, you can have Bitcoin compound at a negative 6.7% compound annual growth rate over time. So at a Bitcoin price of $47,554, and you'd still be better off. You'd still be better off of having issued MSTR equity. And so as the mNAV rises, you see that this is the deleveraging component, right? It makes sense to use these tools when the mNAV is rising, because it is deleveraging the balance sheet and it's providing protection on the balance sheet. And you see as you go further out on these other instruments, these are more torqued instruments. They have different risk profiles. So, right, looking at the convertible bonds, the compound annual growth rate at a 4x mNAV. If you issue a convertible bond at a 4x mNAV, the compound annual growth rate on Bitcoin can be negative 4.7, and you'd still be, that's the break even point. The Bitcoin price would have to be $58,666 to break even. So you'd say, yeah, issue that instrument. And you see as you go further out here on the risk curve, if you issue Strife because it's fixed, they're zeros, right? The compound annual growth rate is 0 for the entire time. So again, this is like the entire presentation is establishing and laying the groundwork and for this risk framework on how companies can think about a Bitcoin balance sheet. Next slide I was going to look at is 62, which is why does MSTR trade at a multiple to Bitcoin to BTC net asset value? I'm just going to show this on the slide. I don't need to go through every one of these. Saylor spent, 20 minutes on the slide and understanding that there are many, many reasons why MSTR trades at a material multiple to net asset value. So all laid out here, compliance advantage, credit advantage, higher volatility, options markets deep. You've got significant other products that are trading volatility on it. You've got leverage products. You've got convertible bond products, inclusion in index funds, which I talk about a lot, brand recognition, international markets, significant Bitcoin exposure, the whole deal. So a lot going on there. This has been part of my primary thesis since the very beginning. MSTR is going to trade at a multiple. All stocks trade at a multiple. And there's significant interest in holding an equity or another instrument in like a brokerage account as opposed to holding a commodity, which I completely agree with. This slide is great. I tweeted about this afterwards, the strategy to maximize shareholder value. So I think, what did Saylor say? He said, we're going to prioritize making MSTR go up as high as possible. We're going to, on the news, what? MSTR goes up high as possible. It's like Bitcoin goes up high as possible. What did I say? What did he say? We're going to drive up the price of MSTR, goal 1, outperform BTC, and then increase the mNAV. So it was nice to hear him say that, right? I know a lot of people have been, trying to get in the brain of Michael Saylor and been really loud on X and Twitter and just saying that Saylor just keeps hammering down the mNAV because, he can, it's accretive. He's going to do it forever. So it was nice to hear him say, right, we're going to support the mNAV. We're going to seek to drive it up over time. with intelligent leverage. And I think we're at this really unique point in time where every Bitcoin put on your balance sheet is just incredibly valuable in giving you the opportunity to leverage your balance sheet into the future. And if we're talking about a future of investment grade Bitcoin products hitting the market, you need a really strong balance sheet, and it needs to be undeniably strong. And I think we're arguably getting to that point right now where Strategy has an undeniably strong Bitcoin balance sheet, holding $52 billion of Bitcoin and only having $10 billion of debt on the balance sheet. So we've got an incredibly low leverage ratio, and the instruments that they're offering the market are just incredible. So let's keep cooking here. So on slide 63, and then we get into this credit analysis, which is super fun. I'm really glad I quit my risk management job, and now I get to think about building the future of Bitcoin risk management and thinking about credit in this market. So this is right up my alley, and I think it's I've got some interesting perspective on this moving into the future. So let's talk about slide 66. Okay, slide 66. This was an excellent presentation on looking at Bitcoin risk for credit analysis. So I'll try to explain what's going on here, and because I think this slide is incredibly important. So Saylor came up with the idea of BTC rating, which is effectively how over collateralized your balance sheet is on each one of these individual instruments. So the BTC rating for like, I don't know, Striker Strife is like 5.5. And what he's trying to put into perspective here is looking at the probability of being under collateralized during a 1-year horizon. And this is a really important framework, right? Because what a lot of people are concerned about is, what if Bitcoin drops 80%, 50%, 60%, whatever that number is. And so what this is putting into perspective is an assumption of Bitcoin's volatility up at the top. You can see the different volatility metrics here. So you got 30% volatility, 40% volatility, 50%, 60%, 70%. What we're seeing is that Bitcoin is maturing as an asset. So it historically has been very high volatility, but it is reducing volatility, and it will reduce volatility as it becomes a multi-trillion-dollar asset. It will reduce volatility over time. There's going to be less supply on the market, and I think the volatility will reduce. It's just a mathematical equation. So depending on your assumption of volatility, you could follow this matrix, and you could go down on the risk curve here. This is effectively like a multiple different risk curves. And you can look at the probability that the assets on Strategy's balance sheet will be worth less than the debt on Strategy's balance sheet. And that's the purpose of this. So you look at, right, if you've got a 5x BTC rating, so if you're 5 times over collateralized and you've got a vol of 50, there's a 0.15% chance that the assets held on the balance sheet are under collateralized during that 1-year horizon. So like, a lot of people can't conceptualize probabilities, right? Like we're talking 1/10 of 1% probability, 1/10 of 1% probability that that the BTC held on balance sheet is worth less than the debt held on the balance sheet. So as you further over collateralized here, you start to look at the probabilities, and there's zero, right? There's zero for all practical purposes, right? If BTC's got a volatility of 0, or got a volatility of 40, and you're 6 times over collateralized, you've got effectively a 0% probability that you're underwater on any of these pieces of debt. So if you have these probabilities of 0%, you'd probably say, hey, you're under leveraged. You should probably take on some more debt. But another way to look at this, and Saylor has outlined this very well, and with a green outline. So anything within this probability matrix here, within the green outline and these different volatility assumptions, is effectively investment grade. So if you're under 100 basis points of theoretical risk, you are an investment grade security. This is an investment grade security. And the difference between investment grade and junk grade is you could see it move pretty quick, right? So if your collateralization level drops, right, if the price of Bitcoin drops, then these then these products become inherently a little bit more risky. So if you're only 2x over collateralized, with Bitcoin volatility of 50%, you have a 12% chance that the assets held on your balance sheet is worth less than your debt. And this is just so incredibly important to understand, because anybody, if you're investing in the Bitcoin ecosystem, in the Bitcoin space, we're going to see 100, 200, 500, 1,000 companies start to operate and adopt a Bitcoin treasury strategy. Now, what a lot of people don't understand is that all of these companies are going to do this differently, right? Strategy's laying the playbook. They're doing a fantastic job. It's very clean, clear cut, professional, investment grade. And they've got $50 billion of this. So it's imperative that they do this in this fashion. Now, some of the smaller companies that are adopting a Bitcoin treasury strategy, they might be a little bit more aggressive, and they may issue instruments to the market that are a little bit further up on the like credit curve, right? Like they may have a significantly different risk return profile than what strategy is offering to the market. And so I caution anybody that's investing in any of these other products, like if you're not a professional investor, just understand that the risk return profile may be significantly different, and it's helpful to understand the collateralization level. So how leveraged is the balance sheet in totality relative to the instrument that you may be buying? So I thought this was just incredibly well laid out, and I love the framework. I'm looking forward to using some more of this in the future. And then I want to go to 68 and 69 because I thought these slides were just fantastic as well. So 68 and 69, this is outlining Strategy's current debt on the balance sheet, the preferred stock, and their liabilities, and basically the construction of the capital structure, and his perspective on the credit quality of each one of these instruments and how much risk is associated with each one of these instruments based on two different assumptions on Bitcoin compound annual growth rate, AIRR. So this first slide is assuming a 0% BTC ARR, and the second slide is assuming a 30% BTC ARR. So this one assumes that Bitcoin doesn't go up at all, right? This assumes, this is outlining the credit quality of each one of these instruments, assuming Bitcoin goes up 0% compound annual for the next 10 years. This next one outlines Bitcoin's going up 30% compounded for the next 10 years. So I'll focus your attention on the only column that really changes here, which is the BTC credit column. And so here's all these different instruments, right? Here's the notional value. This is the cumulative notional value based on, when they mature. Here's the duration. Here's how many years you've got left on it. Here's the BTC rating. So this is effectively how over collateralized are each one of these instruments. So this instrument, the 2028 convertible bond, has a BTC rating of 52. So the BTC risk outlined here is 0%. So the BTC credit is 0 basis points. And maybe we'll go back to this framework here, right? You look at a BTC rating of 50 and you're not even on this map, right? You're down in this like incredibly low probability that the assets held on balance sheet won't be less than the debt held on balance sheet. Now, as you go down into some of these other instruments, because these come due before these other ones, the BTC rating drops, right? Because you're taking on more leverage on each one of these individual like accretive instruments. So the BTC rating is dropping as you go further down the curve here. It's just based on the seniority and the duration of each one of the instruments. So again, assuming 0% ARR, the BTC risk on the convertible note in 2029 is 21 basis points. And you go further down here, you look at the 2032 instrument. So the furthest out piece of debt, right? It's $800 million. They've got a 6.4% or 6.4x BTC rating. So just meaning incredibly over collateralized. The BTC risk in this framework is 9%, and the BTC credit is 238 basis points. So again, going back to this framework here, so you've got a boom. Somewhere around here, the 2032 instrument is still falling within this investment grade horizon, right? And uh, then he also is pointing out the market credit spread. So this is basically what the yields are on each one of these instruments. And so it's outlining the spread premium being, how much this is like I think I like to think of this as like the risk adjusted yield that you're getting for any one of these products. So you're getting 1,000 basis points to hold this product over and above the actual risk, right? So that's what it's trying to point out. So we're saying based on this risk framework, 0% Bitcoin ARR, Bitcoin doesn't go up at all over the next 4 years. There's a 2.38% chance that the assets are worth less than the debt, but it's paying 1,250 basis points. That means your real yield that you're getting over and above the actual risk is 1,000 basis points, which is why Saylor's pounding the table that this is just an incredibly undervalued product, because you're looking at the relative yield relative to some other things in the market. And I brought this up on our last night's stream. We've got, and maybe it makes sense to pull it up. So PG&E, and this is just such an interesting instrument. So this is PG&E. PG&E has preferred stock. The current PG&E preferred stock is paying a 6.8% yield. The current risk-free rate on the 10-year treasury is 4.19%. So the spread on the risk-free rate is you're getting 267 basis points over and above the risk-free rate. But you have to think there's significant risk with PG&E, right? So PG&E, as you can see in this little blurb here, PG&E was deemed liable for this 2018 Paradise Camp wildfire loss. If you guys don't remember that one, it was absolutely massive. It like wiped out 15,000 homes in Paradise, California. Just an incredibly huge loss. The insurance companies all sued PG&E. PG&E was like, oh shit, like we had faulty wires, like the legislative landscape is horrible, like we're gonna have to pay out all this loss. So they paid out $4 billion of loss, maybe 5. And the all of the credit rating agencies said, they said to the state of California, hey, state of California, we're going to downgrade PG&E to junk bond status unless you set up a backstop for PG&E to unless you set up a wildfire liability backstop for PG&E to dip into if they have a future wildfire loss. So now the state of California has backed up PG&E. But anyway, the point here is like the risk profile of this instrument that's rated by a credit rating agency is just absolutely massive, and it's probably significantly greater than 267 basis points over and above the risk-free rate. And then you look at these other instruments that Saylor's got in the market, and you're like, well, if I think the risk of, I don't know, even looking at Strife, right? If I think the risk is 470 basis points, I'm going to get paid 675 basis points. So I'm getting paid 205 additional basis points over and above the risk. And just comparing the relative risk here is huge. Basically, I think all of these instruments in the traditional market are probably underpriced. And I think every instrument that Saylor and the strategy team currently have in the market are probably significantly underpriced. So I think that's what he's kind of pointing out here. And this again assumes Bitcoin doesn't go up at all. It goes up 0%. Now let's look at Bitcoin going up 30%, which I think is a conservative estimate, right? Like this is just the maximalist estimate. He put in triple maxi up there, which goes up 50% ARR. And you start to look at these products, right? And it's like, well, what is the chance that any of these products are under collateralized at some point in the future? And you look at this convertible debt in 2032, which has got a credit spread of 14 basis points, right? And the reason being is because Bitcoin is going up at a 30% compound annual growth rate. That means there's going to be continuously over collateralized into the future. And so the spread premium here, you're getting 1,236 basis points to hold this product. And it seems like a total no-brainer, right? If you want fixed income instruments, these are incredibly underpriced, and the market should be like chomping at the bit to get on these things because they are really valuable if you have an understanding of where Bitcoin is going, and that this is just like the whole thing's reflexive, right? Because as strategy gathers more capital in the door from offering these instruments, they're buying more Bitcoin, which is really just continuing to put more investment and value into the underlying commodity held by strategy. So again, looking at the looking at the relative spread of premium here, the strike instrument, you're getting paid 600. If you think Bitcoin is going up at 30% compound annual growth rate, the risk that strategy can't pay the debt is 13 basis points. So 0.13%, very small. And so you're looking at a spread premium of 687 basis points. Basically, you're getting paid a ton of money to hold these instruments. They just have a ton of value. Okay, that's probably enough there. Let's kick it off over here. And this is a really interesting framework just because it shows the BTC volatility over time and the different compound annual growth rates and how the credit improves at these different compound annual growth rates. So even if you thought Bitcoin was going to go up 10% a year, you're looking at just the risk profile of all of these instruments is incredibly small. And if you think it's going up 30, it's negligible, right? These are all investment grade. And what a sailor had mentioned is, going to this is these instruments are going to be the investment grade Bitcoin treasury instruments, and that can only be done from somebody that's consistent in the market, educating the people that they're trading with, and operating very consistently and transparent with the rest of the market, right? If you want to issue $1 trillion of this stuff, you got to do it very transparently, and you have to just communicate very effectively to the market, which is what this entire presentation was about. And then maybe the last slide here was slide 71. 71, 72. I like these two. This is just showing the credit comparison. So, right, if you think Bitcoin, so on the bottom, this x-axis is different assumptions on Bitcoin compound annual growth rate. And basically, at any one of these assumptions, like if you think Bitcoin's not going up at all over the next 10 years, yeah, okay, some of these instruments might be above the junk bond threshold. But if you think Bitcoin is going up 10% or greater a year, these are all effectively investment grade fixed income instruments and provide significant value to the market. And this is just the inverse, showing the investment grade threshold. So you've got this is volatility, I believe. Yeah, this is different volatility of Bitcoin. So if you think, this like standard deviation of the average mean, and if you think Bitcoin volatility is reducing over time, not increasing, then these are more investment grade products than non-investment grade products. And then I think the last slide I had here was, this over collateralization and credit spreads of traditional bonds. So this is just going to show, he explained this very well. This is explaining the most traditional finance companies. They're taking out debt for a future promise of revenue earned in the future to be able to pay the debt at a point in time in the future based on the revenue that they're bringing in the door. Basically, they don't have the money right now, so they want to borrow the money and then pay it back at a point in time in the future because of the revenue they're going to generate. Now, you've got this interesting dynamic here with strategy that they're significantly over collateralized. They have the money, but they want to borrow more money and be able to pay it back at a point in time in the future. So very, very valuable risk return trade-off relative to some of the other instruments in the market. And I think this is important because if you look at this PG&E, I looked this up. So that PG&E preferred stock that I just outlined to you is a credit rating of BB plus. So Fitch rated this preferred stock instrument at a BB plus rating, and which has got significantly more risk than what strategy is running with their collateralized balance sheet, right? It's got like a $36 billion market cap, potential for massive losses that are just completely enormous. And then those losses can happen annually, or just a really difficult business model. And now you have And then comparing these instruments, right? You're like, how on earth? Like, why is this not investment grade? Like, what do you mean PG&E has got a BB plus, and these instruments aren't rated? What do you mean you can't rate them? Right? What do you mean you can't rate these instruments? They're they're the safest thing in the market. And I think that's why there's this call to action from Saylor to, send this message to the rating agencies. And, education here is incredibly important because people need to understand uh, the underlying framework with Bitcoin, the value proposition of Bitcoin, and where this could potentially go. So, as you can imagine, there's a significant unlock here with there's a significant unlock here if any of these companies like Fitch or Moody's start to provide ratings on these instruments, because it's going to be a flood of capital coming in the door from this stuff. So yeah, I think that's pretty much it. That's all I've got. I mean, Jesus, what a totally amazing presentation. And then afterwards, like, our BTC principles just continued to outline we're going to buy and hold BTC indefinitely. This is just really good, like just classic transparency framework. We're going to buy and hold BTC indefinitely, prioritize MSTR common stock. And it's just a great framework to emphasize the transparency of the equity. So yeah, just incredible. I'm going to be digesting this for weeks. Look forward to seeing anybody that's going to Strategy World next week. Please come by, say hi. We've got True North World on Monday. Going to be a ton of fun. I got to finish my keynote speech on that, but I had to get this out before I could finish that, or else I would just be thinking about this way too much. Yeah, and I think that's pretty much it. The future is so bright. The future is so bright for this stuff, and I'm excited to be here. Excited I've left my job to come do this full time. So 47 minutes. I got through it. Thanks for taking the time, and